Hi, hello everyone. Welcome back to my channel. In this video, there will be a discussion on the non-availability of the input tax credit, the time limit for availing the input tax credit, debit note, credit note and their contents, bill of supply, then the manner of availing the input tax credit. Kindly watch the video till the end, like, share and subscribe. If you have any comments about the video, please put your comments in the comment box. Now, let us move to the presentation. So when it is looked into the non-availability of the input tax credit, section 17 subsection 5, which classifies the inward supply into two cases, that is value addition and overheads. Here value additions are nothing but those purchases of the goods or services which will further use in the manufacturing or rendering of the services in creation of an output in the production. For example, the raw materials which can be used or the semi-finished goods may be given a touch of a finished goods, which is nothing but a value addition to the business. Whereas the overheads are those purchases of goods or services that do not directly contribute for the creation of an output. So in this case here, in order to get the incentives, the government can either give exemptions or it can offer input tax credit claiming mechanism, and it disincentives overheads to balance its financial resources. So now let us look into on which the input tax credit cannot be claimed by a registered person. Input tax credit cannot be claimed on motor vehicles and the conveyance here. Here the ITC cannot be claimed on the motor vehicles and the conveyances which are used. Further, supply of such conveyances, if the motor vehicles are meant for personal consumption, say for example, if the proprietor makes or if the dealer makes use of the vehicles for his self-consumption, then in such case he is not eligible to claim any ITC here. If the vehicles are used for the transportation of the passenger, then it can claim the ITC. If such motor vehicles are used as for the transportation of the goods, in such case they can be claimed as on which they can claim the ITC. To give an example here, for example, assume that there is a company called as ACUS, which makes use of the vehicles for the purpose of transportation of their employees, that is a pick and drop. In such case, the ITC can be claimed. Suppose if the same way, if other vehicles are used like goods carriers used for transporting the goods from one place to another place in the within the industry premises, or to get the goods from the outside to the premises here, on which the ITC can be claimed by the registered person here. So the vehicles used to carry the materials from a store to production plant, so on which the input tax credit can be claimed. Then the input tax credit is not allowed to claim for the supply of following the goods such as the food, beverages, club membership, others here. However, the input tax credit will be available if the category of inward and outward supply is the same or the component belongs to a mixed or composite supply under the GST here. In other words, to say, as per section 17 subsection 5, no input tax credit is available in respect of the food or the beverages except where an inward supply of goods or services or both a particular category is used by a registered person for making an outward taxable supply of the same category of the goods or services or both, or as an element of taxable composite or mixed supply. Suppose, say for example, if the food or beverages are supplied to their employees In such case, the ITC cannot be claimed. If it outsources of such supply here, in such case, the ITC can be claimed. Then ITC cannot be claimed on membership fees for gyms, clubs, etc. here. Suppose, say for example, a managing director who has taken membership of a club and the company pays the membership fees, the input tax credit will not be available to the company on the payment of such a subscription of the director. Then ITC is not available for rent, cab, health insurance and life insurance. However, the input tax credit is available in case of any services which are made obligatory for an employer to provide its employees by the government under any current law in force. In such case, the ITC can be claimed here. Suppose, say for example, today, if because of this pandemic, if the government insists that the health security measures can be taken by the companies, so if the company spends on such things here, it can claim the ITC here. Say for example, like availing a doctor, or say for example, purchase of the sanitizer, etc., so on which it can claim the ITC here. Then the ITC shall not be available for the works contract services when supplied for construction of an immovable property. However, the credit is allowed where it is an input service for further supply of works contract service. Where it is supplied for construction of the plant and machinery, in such case the ITC can be claimed by the registered dealer here. Then the no input tax credit is available for the goods or services or both received by a taxable person for construction of an immovable property on his own account, including when such goods or services or both are used in the course of furtherance of the business here. So anything which is meant for the construction of immovable property, on which it cannot be claimed. But if the dealer is a supplier which will be used for further the construction of the immovable property, can be claimed by the such dealer here. Then input tax credit cannot be claimed. Input tax credit cannot be claimed by a composite dealer here. A composite dealer is one who has registered under section 10 of the GST Act, whose annual turnover is more than 1.5 crores. In such composite dealer cannot claim the ITC here. The input tax credit cannot be claimed by a non-resident dealer here. However, ITC is available on any goods imported by him. Suppose, say for example, if the person is not of origin of this country and who conducts the business in India, but if he imports the same from his own country for conducting of the business in India, he is eligible to claim ITC here. Then ITC cannot be claimed on those goods or services which are used for the personal consumption but not for the business purpose here. Then ITC cannot be claimed on the goods or services which are provided as free samples, goods lost, stolen, destroyed, written off, or disposed by way of gift or free sample, etc. here. Then no input tax credit can be claimed on the frauds. In other words, to say, if any tax has been paid against an order of confirmed demand on account of any fraud or willful misstatement, then input tax credit cannot be taken off on such account here. Even if the depreciation has been claimed on the cost of the capital of the goods, then they are not eligible for the input tax credit here. So on all these cases here, the ITC cannot be claimed by the registered dealer here. Now let us see for the time limit for availing the input tax rate. So of course only a registered person is eligible for claiming of the ITC here, and such ITC must be claimed within 180 days from the raising of the invoice. Suppose, say for example, if the invoice is raised in the month of January, so it must be claimed by him within the end of June month here. So a registered person shall be entitled for the input tax credit So the section 16 subsection 4, which provides that the last date to avail ITC for the invoices of a particular financial year would be the due date of filing of return under section 39 of CGST Act 2017 for the month of September following the end of the relevant financial year. So here it following the end of the relevant financial year means it is the 31st March, or annual return under section 44 of the CGST Act 2017 for the relevant financial year, whichever is earlier. So, in other words, to say, the time limit for availing the ITC shall not exceed 180 days. Now, let us look into certain provisions of the GST relating to the input tax credit on the capital goods. So, first, before that, we should understand what is capital goods here. So, capital goods which are not purchased frequently by the dealer here. So, in other words, to say, the machines which are used in the manufacturing or furtherance of the business is nothing but what we call it as the capital goods here. So, in generally, capital goods are the assets such as the buildings, equipments, vehicles, and the tools which will be used to produce goods or services here. When it is looked into this, the definition of section 2 subsection 19, which provides the meaning of capital goods in it, the value of which such assets is capitalized in the books of accounts of the person claiming the ITC and which are used or intended to be used in the course or furtherance of the business here. Say for example, if the person purchases any machinery which is used in the manufacturing of the goods, then in such case it can be considered as capital goods here. Now let us look into certain provisions here. So no input tax credit on the capital goods on which the depreciation is claimed by the registered dealer here. In other words, to say, as per section 16 subsection 3, where the registered person has claimed depreciation. So if the dealer has claimed the depreciation on the asset which is used in the business here, in such case he will be ineligible to claim the depreciation on such capital goods here. Then no input tax credit on the use of the capital goods for the non-business purpose and exclusively for exempted supplies here. In other words, to say, if the capital goods are used or intended to be used exclusively for personal reasons, or that is the non-business purposes, and if they are meant for exclusively for effecting the exempted supplies here, in such case no ITC can be claimed by the dealer here. The amount of the ITC in respect of the capital goods used or intended to be used partly for personal or exempted supply and partly for normal taxable sales shall be available to the take credit on a proportionate basis here. The input tax credit for the capital goods will be credited to the electronic ledger useful throughout the useful life of the asset. Once normally the useful life of the asset will be taken as 5 years. So in case if the, say for example, if they are used earlier for non-business purpose and later on if the same is used for the business purpose here, in such case the ITC will be reduced by 5% here. So if the goods are used for first for non-business purpose and later on for business purpose, in such case the credit of ITC will be reduced by 5% there. Then now let us look into the debit note here. Here, as the name itself indicates, here when the goods are supplied are returned, or when there is a revision in the invoice value due to the goods or services not being up to the mark or extra goods being issued, a debit note or credit note is issued by the supplier and recipient of the goods and services here. So a debit note as per section 34 of the CGST Act 2017, which says the issuance of the credit note or debit note is specified, depends upon the situation here. So a debit note is nothing but a document prepared by a purchaser, sorry it is typed as a purchased, by a purchaser when who is returning the goods prepared a memo with the full particulars thereof and sends it to the supplier to whom the goods have been returned. This memo is nothing but what we call it as debit notes. That means here The supplier has sent goods to the recipient here. When the recipient goes through the goods he may come to know that the invoice is overcharged, or the goods delivered, say for example, are damaged. In such case, he is going to return, or what he has ordered, if he receives the consignment in excess of the order, then in such case there is a chance of a rejection here. If for that reason here, so he is going to prepare a debit note and send it to the supplier here. So now let us see the situations which demands for preparing the debit note here. So the amendment of the amount of taxable value of the goods after issuance of the invoice. Say for example, if the worth of the invoice is, say for example, 1 lakh. If the 5,000 worth of goods are returned here, then in such case, the purchaser, that is the recipient of the goods, has to prepare a debit note to the extent of rupees 5,000 for reduction in the value of his invoice here. Then there is another chance that if there is a change in the tax after issuance of the invoice, in such case also a debit note will be issued. So now let us see some circumstances under which a debit note will be issued. The original tax invoice has been issued and actual taxable value is greater than the taxable value of the invoice. Say for example, the actual taxable value is, say for example, 2 lakhs, whereas the taxable value of the invoice is, say for example, 1,75,000. In such case, the debit note will be prepared here. Then the original tax invoice has been issued and the actual tax is more than the tax charged in the invoice. The quantity of the goods received by the recipient is greater than the quantity declared in the invoice. Say for example, in the invoice it is mentioned as 100 units, but if the number of units received by the recipient is 125, in such case there must be reduction in the invoice value here. Under such situations here, the debit note is prepared here. Then the credit note. This is exactly opposite to the debit note here. When the goods are sold or returned to the seller from his customer for some reasons or other, the memo issued by the seller to the customer acknowledging the receipt of the goods is called as a credit note. In other words, to say, it's a document prepared when a customer has been overcharged or is given an allowance for damaged goods. Such credit notes can be issued in GST under the situations of when the goods are returned by the recipient, when the supplier has charged excessive than the actual one, when he has supplied the inferior or quality goods here. So under which the situations under which the credit note is to be prepared here, when the actual taxable value is lesser than the taxable value in the invoice, when the actual taxable tax is lesser than the tax that is actually charged to him. Say for example, if the amount of actual tax is 500, if the tax charged is 600, then in such case he has to prepare. The quantity received by the recipient is less than the quantity mentioned in the invoice. So in such case, the credit note is to be prepared here. Now, the contents of the debit note and credit note, they are similar to each other. Here, what shall be the contents of the debit note and the credit note here? Now, let us see here. The name and address of the dealer supplying of the goods or services. It must be clearly mentioned in his invoice. Like say, for example, Vasavi Provisional Stores, Mumbai. So like this, it must be clearly mentioned. Then GST identification, that is a GST in or GST of the supplier must be clearly mentioned on the invoice on the right hand corner. Then the nature of the document, that is the debit note, it must be clearly written in the block letters as a debit note in a bold and block letters, and it must be serially numbered. So for one financial year, it must be serially numbered. Then from the next financial year, it can start from the first here. Then the date of the issue of the document should also be mentioned there. Then the name and address of the recipient of the goods or services to whom the goods are supplied here. Then even the GST and recipient of the should be also mentioned. This is in case of a registered recipient. If the recipient is an unregistered person here, the name and address and the place of the delivery should be mentioned clearly. And it must carry a digital signature for online debit note, for the physical, for paper-based documents here. Now let's make a distinction between the debit note and the credit note. Of course, a debit note, it is a document which reflects a debit is made to the party's account, whereas a credit note which provides that an instrument used to inform that the other party's account is credited in his books here. A debit note is a representation of the positive amount, whereas a credit note is a representation of the negative amount. Here in the debit note, it will be increased, whereas in case of the credit note, it will be reduced from the supplier's point of view. Updating the purchase return book because of the issuance of the debit note, whereas a credit note leads to the updating the sales return book. A debit note is a reduction of the account receivables, whereas a credit note is the reduction of account payables here. Now let us look into the tax invoice. Of course, invoice is to be issued by the seller to the buyer, which provides details as the type of the goods which are services which are rendered to him, the cost of the goods, then the amount of the GST charge in the form of CGST, SGST, or it may be like IGST here. So a tax invoice is nothing but a commercial document issued by a seller to a buyer relating to a sale transaction and indicating the product quantities agreed at an agreed prices for the products and the discounts, if any, are provided by the seller here. In a very simple to say, an invoice is nothing but a bill. The bill indicates that how much amount is to be paid by the recipient of the goods or services. So which contains the details like the quantity of the goods, then the discount provided, the cost of the goods, everything, and even the amount of the tax that also be mentioned in the invoice. And this tax invoice is basically used for accounting purpose. In other words to say, it is considered as an important document for recording of the transactions in the books of accounts here. So it is a legal document on which both the parties can be challenged here. Then the GST Act, which defines a tax invoice as a tax invoice is an invoice issued by a registered dealer to the purchaser, that is the recipient of the goods, showing the amount of the taxable and issued when the goods are sold with the purpose for resale here. So when it is looked into the features of the tax invoice here, of course it will have it bears a serial number. So which starts from 1 to say till the end of the financial year, it will be serially numbered. Then it is prepared in the triplicate. Why it is prepared in the triplicate? Because to enable all the parties to for a proper dispatch of the consignment here. So one copy, the original copy, which will be handed over to the recipient of the goods when the goods are delivered to him. Another copy that is called as a duplicate copy, which will be handed over to the transporter who is going to transport the goods from one place to the another place here. The another copy that is which is prepared in the triplicate, which is remained with the supplier of the goods for his accounting transactions here. Then let's see what are the contents of the tax invoice here. All the tax invoices prepared by registered suppliers under GST need to contain the name, address, and GST identification number of the supplier. So this is most important because to enable to know the transactions made by the supplier here. It must be consecutively that is a serially numbered, not exceeding 16 characters in one or more series containing alphabets or hyphens or the special characters or dash, and it must be properly dated. So in other words to say, there must be a date on the invoice, the name and address of the recipient and the address of the delivery along with the state and its code if such recipient is an unregistered dealer and where the value of the taxable supply is exceeding rupees 50,000 here. Then it must also carry the HSN code, that is harmonized systematic nomenclature or accounting code of services. It should provide a description of the goods, what type of the goods are dispatched. So all these things that must be mentioned. Then quantity in case of the goods and unit or unique quantity code thereof. Total value of the goods or services or both. The taxable value of supply of goods or services are both taking into account or abatement if any. That means the discount and for each product or the total discount, all those things that must be mentioned here. It must also include the CGST paid by the recipient, SGST charge or IGST charge or UTGST charged to him. It must also contain the amount of the tax charged in respect of the taxable goods or services with a breakup of CGST, SGST, UTGST. Then it should also mention the place of supply in the course of interstate trade or commerce. It should carry the address of the delivery where the same is different from the place of supply, trade or commerce. So that's why you might have seen why if you are ordering with the e-commerce dealer, it will ask the place of supply as well as the delivery of supply, because the order may be made from one place but the goods may be delivered at another place. That is also possible. So that's why whenever you go for ordering any goods on online, it asks whether the delivery place and the place of should remain is it remaining same as. Then he should carry the signature or the digital signature of the supplier of his authorized or his authorized representative. In case supply of the goods and services are both by an unregistered dealer to the registered recipient, the recipient has to raise invoice and shall bear the signature of the recipient here. Now let's look into the another document called as a bill of supply. A business registered under GST issues a tax invoice to the buyer, such an invoice which provides the details of the GST rate charged, the cost of the goods, etc. here. But in some businesses, even though a registered under GST cannot charge the tax and the goods supplied by him, such dealers have to issue a bill of supply. So a bill of supply is nothing but a document to be issued by the person supplying exempted goods or the services or both, or paying tax under the provisions of section 10, that is a composition scheme, instead of a tax invoice. So in other words to say, it is issued by a composite dealer or the dealer who is involved in exempted supplies. So such person will issue the bill of supply. So in other words to say, it is issued on with when the GST is not applicable. That means if the GST is not chargeable on supply of the particular type of the goods here, in such case the bill of supply will be raised in the name of the recipient. So it will be issued by the dealer who is involved in supply of exempted goods or services, and it is issued by a composite dealer and even by an exporter. So now let us look into certain features here. Of course, a bill of supply is a commercial document. It is a document issued by a registered person supplying exempted goods who is involved in a composition scheme or who has registered his name under composition scheme, issued where the GST is not applicable, and it will not disclose the amount of the taxable as they are not at all taxable under the GST itself. Then it should provide the details of the description of the goods, the quantity and the value of the goods that is supplied by the supplier here. So let us look into the contents of bill of supply here. Of course, it should contain the name, address and the GST identification number of the supplier. It should be serially numbered. It will have a unique number for that particular financial year, and it should be properly dated. If the recipient is registered, then the name, address of the GST identification number of the recipient. It should also contain the HSN code of goods or accounting code for services. It should provide a description of the goods like the quantity and the rate per quantity, etc. All these things. And it should also include the abatement provided, the tax charged by the supplier to the recipient, everything that must be mentioned here. Signature, it should carry the signature or digital signature of the supplier here. Then, now let's make a distinction between the tax invoice and the bill of supply. Here a tax invoice is the invoice issued by a registered dealer to the recipient showing the amount of the tax payable by him and issued when the goods are sold within with the intention of for resale. I mean to say, when the goods are further used for resale here, further sale here, in such case this tax invoice is used. Whereas the bill of supply, a document issued by a registered person supplying exempted goods or services, or both are paying the tax under the composition scheme. That means the registered persons who are covered under section 10 of the CGST Act of 2017, they are supposed to issue the bill of supply. Then the tax invoice provides all types of taxable sales. Then whereas the bill of supply is issued for all types of exempted sales or sales by a composition dealer or by an exporter. The tax invites the bifurcation of the CGST, SGST, and the amount of the IGST or UTGST to be paid by the recipient here. So that's why whenever you purchase any good, whenever the bill is raised or when the invoice is raised here, you can clearly ascertain at what rate it is the goods are subjected to tax, whether is it at 5%, 12%, or 24%, etc. So like this it will be mentioned. But whereas in case of the bill of supply, no taxes to be shown on bill of supply here. The tax invoice contains the name, address, state, place of delivery is compulsory required if the value of invoice exceeds rupees 50,000. This is applicable when the supply is made to an unregistered person here. But in case of the bill of supply, where there is no difference between the there is no difference of supply to either registered person or unregistered person here. The tax invoice is used in case of both intra and interstate supply, whereas the bill of supply is used only by composition dealer, and in case of exempt supply, sales can be made to both, that is intra and interstate supply here. Then now let us look into the availability of the ITC in case of the special circumstances. The special circumstances are enumerated by section 18 of the CGST Act here. The ITC is available on the opening stock at the time of registration here. A person who has applied for registration within 30 days from the date on which he becomes liable to registration here and has been granted such registration, the input held in stock or capital goods, person shall be entitled to take credit of ITC in respect of inputs held in stock and inputs contained in semi-finished goods or finished goods held in stock other than capital goods on the day immediately preceding the date from which he becomes liable to pay tax. Say for example, if the person is liable to pay tax on 1st September and has obtained registration on 15th September, in such case he is eligible for ITC on the inputs held in stock as a part of semi-finished goods or finished goods held in stock on 31st July, and he cannot claim ITC on capital goods. Then ITC is available on the opening stock of the inputs at the time of voluntary registration. Here voluntary registration, all of us we know that even though the person does not cover under the GST Act, but on his own he applies for the registration with an intention to claim the ITC here. So in such case, a person who takes registration under section 25 subsection 3, that is voluntary registration, shall be entitled for ITC here. The inputs held in stock or capital goods, the person is entitled to claim ITC on only the inputs which are held in the form of semi-finished goods or finished goods, but not on the capital goods on the day of immediately preceding the date of registration here. Then the ITC is available on opting out of the composition scheme. A dealer who has registered under the composition scheme and thereafter he wants to cease to be a composite dealer here. In such case, where any registered person ceases to pay the tax under section 10, that is a composition scheme, he shall be entitled for ITC here. The person shall be entitled to take ITC in respect of the inputs held in stock and inputs contain semi-finished and finished goods in stock and capital goods on the day immediately preceding the date from which he becomes liable to pay the tax here. Then the ITC is available on the conversion of exempt supply into taxable supply. So the person who is involved in supply of that exempted will now start the supply of the taxable goods or services. In such case, he is liable for the ITC here. Then now let us look into the manner of utilization of the ITC here. So the ITC on the IGST can be used to pay first IGST, then for payment of CGST and SGST. So it must be orderly paid here. Then ITC of the CGST can be used to pay first CGST, and if balance remains shall be used for payment of the IGST. The credit of CGST cannot be utilized for payment of the SGST here. The ITC of SGST can be used to pay first SGST and balance for payment of the IGST. The credit of SGST is not allowed to pay CGST here. If the ITC is greater than the CGST payable, excess ITC is used to set off IGST. Please do remember here, if the ITC is more than CGST payable, then ITC is used to set off first IGST. The ITC is more than SGST payable, the ITC is used to set off against IGST. If ITC is more than the IGST payable, excess ITC used to set off against the first CGST, then SGST. So it must be adjusted orderly here. So it cannot be interchanged here. If any excess ITC is still remaining after adjustment, then in such ITC shall be carried forward till 180 days. It can be carried forward. From 181 days, it cannot be further carry forward here. So this is how the registered person should utilize the ITC for the payment of the tax liability here. Thank you for watching this.